Okay, and we are streaming. All right, guys, welcome to today's presentation regarding the residential property macro market outlook for 2023. Now, I'm going to break this presentation into a few parts. So, number one, we're going to have a quick recap of 2022. We'll have a look at where the current economic and property drivers are. And then we're also going to make a few predictions on where the property market is heading for the remainder of the year. A few disclaimers as well. We're only looking at residential property market and we're looking at the macro market as well. So we're looking at the property market as a whole, as a nation. Now, we will have the opportunity later on in this presentation to look at some of the sub-markets, but by and large, we're looking at the macro market going forward. Okay, so without further ado, let's get into it. Now, first up, just a quick disclaimer, doesn't contain any financial advice. Everything that I mentioned in today's presentation is my opinion only, based on the research and data that I've collected. Okay, so quick recap. So 2022, what has happened? So look, it's no secret that the overall property market in Australia experienced a bit of a downturn. But it's worth noting that not all of the nation's property markets were impacted equally. So each state has its own stage of, is in its own stage of the property cycle. And within each location, there are multiple markets and there are still locations where property values are still rising. So as an example, back in beginning of 2022, we made a few bold predictions ourselves. For example, we predicted that the North Adelaide housing market will experience a massive boom, and these included, areas like city of Salisbury, Andrews Farm, Para, Elizabeth, etc. And we were right. This region across the board experienced between 25 to almost 35% growth year on year, which is absolutely amazing. Another place that we also predicted was the New South Wales mid-central coast, areas like the Southwest Rock, Redhead. And, looking at Southwest Rock, that experienced 37% growth year on year. Again, phenomenal. We're also looking at we also looked at the Western Melbourne market, areas like Melton South, Strutterlow, Cobblebank. And we're also right in the sense that these areas were the number one growth areas in Melbourne year on year. So Melton was one of the best performing suburbs in the Melbourne, the greater Melbourne region. So all our members who bought into these areas have done extremely well last year. So what's happening right now? Where are we right now? Well, let's have a look at some of the key sort of market indicators. What's worth noting is that the property prices over the last couple of years or since the pandemic has grown considerably. And the regional property markets have performed even better, especially if you compare it to the last property cycle, last property boom. So right now, what we are in right now is the adjustment phase of the property cycle. By no means are we in a property market crash. We're nowhere near a property market crash. It is a orderly correction that has to occur because of the massive property price soar that we've experienced since the pandemic. And looking at the table here, we can see that all the major cities, including regional areas, have experienced massive growth ever since the pandemic. Even though we've had some declines since the peak, we are still way ahead than where we were before, prior to the pandemic. Now, if we look at the table as a graph, we can see since April 2020, every major city and regional area has gained significant value across the board. And what we're doing and what we're experiencing right now is also a rental crisis. So rents, we are experiencing one of the lowest vacancy rates in history, and as such, we are experiencing major uplifts in rents. So we're experiencing a rental crisis at the moment. So if you're looking at the chart here, we can see year on year there's been massive growth in rentals, both for units and for houses as well. So going forward, what are some of the predictions? So let's have a look at what some of the government bodies and experts are predicting before I provide my own predictions. So if you read this particular news article with the title, property prices will fall 30%. This is an article that was written in the Australian Financial Review towards the end of last year by a pretty respected columnist. But the fact is, a fall of this magnitude, 30%, has never happened before. It didn't happen during the massive recession in the 90s. It didn't happen during the global financial crisis. And it didn't happen during the credit squeeze between 2017 and 2018. As a matter of fact, since 1990, there's only been 5 periods where we've had a correction. As you can see from the chart here, we've only had 5 corrections, and none of these corrections were more than 6 or 7%. So the fact that people are predicting 30% fall in the property market is pretty ridiculous in my books. And I also want to just remind everybody that every time we have a property boom, the following downturns has been very, very small compared to the previous rises. So we've always had massive property booms and then very little corrections. So looking at the table down here, looking at the chart down here, we can see the period between 1995 to 2022. We've always had massive upswings compared to various minor downturns. So the green bar here represents the upswings during that time frame, and the pink bar represents the downturn during the same period as well. So you can see very, very clearly every time the property market moves, the upswings is far greater than the downturns. So what does this mean going forward? So let's have a look at what the RBA thinks. So some of the key drivers for property prices include inflation. So let's have a look at what the RBA sees in inflation. So the RBA believes inflation peaked at 8% at Q4 2022. And it also is projecting that it will continue to slow throughout the remainder of 2023 to 4.7%, and then continue to fall down to about 3.2% over 2024. So this is obviously very good news for most of us and for consumers. In terms of unemployment, what the RBA is forecasting is that the unemployment rate will creep up slightly to 4.5% over the next couple of years. So still within a pretty good range. And what about interest rates? So interest rates, as you know, is a pretty strong driver of property values. It's not the only influence on property value, but it is what most people pay attention to. So if we're looking at the interest rate forecast, there's a wide range of opinions as to when interest rates will peak. So the prediction by the big 4 banks range between December 2022 and May 2023. So RBA believes we've already peaked at 3.1% cash rate. NAB believes we'll peak at 3.6% in March. Westpac and ANZ believe we'll peak at 3.85% in May this year. So what does this mean when it comes down to mortgage stress? Is the further interest rate rises, if there are going to be any, cause mortgage stress and cause fire sales across the nation? Well, here's a few things worth noting. Recently, the RBA performed their modeling and analysis, and they have found that most households with variable mortgage rates are likely to be able to handle an increase of their minimum loan repayments even if the cash rate were to reach 3.6%. So what that suggests is that with an RBA cash rate of 3.6%, it would not cause a major financial instability amongst households. But it is worth noting that ultimately the path of the cash rate is dependent on a number of factors, such as the outlook for inflation, which is a major one, how households respond to the higher rates, whether or not they're potentially tap into their savings, and also whether or not they're going to reduce consumption as well. So here's some of my thoughts as to whether or not we are going to experience some mortgage stress and fire sales. Well, my thoughts are the net wealth of property owners over the last few years since the pandemic has improved significantly. So mortgage stress is probably not on the tables. Secondly, the banks have been very conservative over the last few years with their lending practices, and they check serviceability based on the assumption that there will be a 2.5% to 3% interest rate rise. Thirdly, many Australians have built up significant savings and have put them in the offset account, and many mortgage holders have actually paid their mortgage in advance. They're actually in front of the mortgage repayments. Half of Australian homeowners are debt-free, and those who recently purchased properties, particularly before 2020, have experienced significant uplift in the equity. The economy overall is still growing strongly. Unemployment rate is still low. So inflation in interest rates is not really a major concern. The Australian property market is also too big to fail. Most people actually don't know this, but the Australian property market is larger than our equity market. And the banks don't want to see a drop in property value because it will affect them dramatically. And as I covered off, the RBA modeling suggests that most households will be able to handle a cash rate of 3.6% without causing any financial instability or any financial stability concerns. Okay, so let's talk about property price forecast. So what does all this mean for property prices? So the big four banks are relatively pessimistic, and they are predicting price fall of between 8% to 11.4%. Now, it is worth noting that these banks have been known to be very conservative in their forecasts. They've also been known to be wrong, and their outlook is not shared by all experts, including myself. So have a look at the table here. The RBA believes that property prices across the nation, again, we're talking about the macro market here, RBA believes it's going to fall by 8%. NAB believes it's going to fall by 11.4%. Westpac, 8%, and ANZ believes it'll fall by 9%. Now, let me just remind everybody that the big banks have been wrong before, and they have been very, very wrong before. Just going back to 2020, their 2020 predictions, most of them predicted a 10 to 15% decline in property values. And what did we experience in 2020 and 2021? About 25 to 30% growth across the nation. So that is a 30 to 35% swing on the prediction. So how can they get this so wrong? Well, the answer is the banks have their own agendas, so which I won't get into in today's presentation. So let's have a look at some alternative forecasts. The SQM research offers a more optimistic outlook. So their reports outline 4 possible scenarios, with the base case where they predict that growth can range from between 3 to 7%, and the best case can see growth between 5 to 9%. So compared to what the big banks are saying, that's about a 20% swing. All right, and it's also worth looking at the table here to see that some of these major cities are going to experience some double-digit growth. So here's some of my thoughts about what is underpinning the housing market. So in my opinion, there's still very strong fundamentals that are underpinning the property market. So we are most likely not going to experience any significant downturns. Okay, number one is there's still a shortage of good properties for sale. And there's next to nothing available for lease at the moment, available for rent because of the rental crisis. International migration is increasing, and this is going to increase the demand for housing. So think about this. What do migrants do when they first come to Australia? They look for a place to live, whether they rent or they buy. So there's going to continue to increase demand for housing. We're experiencing a slowdown in construction. So there's very little construction coming into the market right now because of rising construction costs due to shortage of labor. So supply is dropping while demand is increasing. The economy is still growing, unemployment rate is still low, and people are still able to afford their mortgage repayments. Wages are increasing, particularly white-collar professionals. Most households have a strong balance sheet with significant savings. Many borrowers, as I mentioned before, are ahead on their mortgage repayments. The banking system have had very strict lending criteria and still have strict lending criteria. And there are very few non-performing loans. And lastly, the government is providing pretty good incentives for first home buyers to get into the market. So as you can see, we have some pretty strong fundamentals that are underpinning the housing market. And the fact is, there are still a lot of people in the market at the moment. Figures show that at the end of November 2020, over $28 billion worth of finance was approved, meaning homeowners and investors are currently in the market with a budget of over $30 billion to spend. Breaking this down, demand from homeowners or home buyers are expected to continue. The advantage is home buyers now are a little bit more selective, and they're going to go for good quality properties. And this is going to underpin the values of good quality properties going forward. As you can see from the table here, that's a breakup of the housing finance approvals by state. Demand from investors will likely continue as well. And unfortunately, they're going to squeeze out a lot of first-home buyers. As rents are increasing, the share of first-home buyers will probably continue to drop. And strategic investors with a realistic long-term focus are going to start returning to the market. As you can see, there's over $9 billion of loans approved for investors, and majority of it is for New South Wales, Victoria, and Queensland, and obviously some of them for New South Wales, for Western Australia and South Australia as well. What we can also expect is rents will continue to rise and rise very, very strongly. The thing is, we are currently experiencing a rental crisis, and this is expected to continue for the next few years, because whenever there's increase in rental demand at a time where there's historically low vacancies, it will inevitably see rents increase. So as you can see from the table here, we are at one of the lowest vacancy rates in recorded history. As a nation, vacancy rates is at around 1%. And with the increase in demand with migration and the slowdown in new constructions, we can expect vacancy rates to remain pretty low for the foreseeable future. And as you can see from the chart here, and particularly worth noting that when our international borders open further, and when we when we start seeing foreign students return, we're going to start seeing increased pressure on rentals, particularly around the CBD apartments. So as you can see from the chart here, year on year, we're experiencing double-digit growth in rents, both in houses and for apartments, for units as well. So the question is, you might have is, well, should I buy now or should I wait? Well, it's very important to remember that property investment and curating financial freedom is a long-term process. It's not just a one-off event. So instead of trying to predict the perfect time to buy, it's more important to figure out that whether or not you are financially and strategically prepared to invest in real estate. That means you need to have stable income. You need to have a strategic investment plan. You need to have the right ownership structure for asset protection. And also you need to have a robust financial strategy as well to protect yourself from any potential downturns. And also, this is worth considering. There are over 15,000 suburbs in Australia. So can we assume that there might be 10 to 20 suburbs that's going to provide good buying opportunities, that's going to outperform the rest of the property market, that could potentially grow double digits in 2023? Well, if you're asking me, I think there is potential that there could be 20 or more suburbs that's got good buying opportunities. So if that is the case, then where are some of these locations and how do you find them? So through our research and through our analysis of the markets across the nation, there are probably 10 locations that are worth noting. There are 10 locations of interest. And here's what they are. So here are 10 locations of interest that we believe are worth investigating further. So the city of Ipswich in Queensland, Toowoomba in Queensland, Townsville in Queensland, Tamworth, New South Wales, Wollongong, New South Wales, the city of Okaparinga in South Australia, the city of Salisbury in South Australia, the city of Hume in Victoria, the city of Greater Geelong in Victoria, and the city of Rockingham in Western Australia. We believe these locations are definitely worthy of further investigation. And that's exactly what we're doing right now. So for each of these locations and many more, we are putting together research-backed data reports, which look a little bit like this. So, if you're interested in studying and getting further information on these sub-markets, then feel free to reach out to us. So a lot of these reports are only exclusively available to our members. And if you want to get some further details, further research on some of these sub-markets, please reach out to us. So here's what's next. So you basically have a choice to make right now. So based on all the information that I've provided in today's presentation, you can either continue sitting on the sidelines and waiting for the market to continue to grow, meaning it's going to be harder and harder for you to get into the market, or you can choose to get into the market and continue to grow or start your property portfolio. Now, mind you, obviously, if you are a first or second time property investor, it's very, very important that you have the right strategic investment plan. It's very important that you have the right strategy going forward, because if you buy the wrong property or you make a mistake, it could cost you decades. It could cost you years. So if you are interested in exploring opportunities, or you just want to talk to a professional and get some opinion as to what you want to do, then feel free to reach out to myself and my team. I'm more than happy to sit down with you and have a chat and give you our advice as to what you can do, what you should do. The other thing also, before I let you go, I'll provide down below a link to our masterclass video where I go into specifics as to how you can build your portfolio, how you can use your equity in your existing home to multiply your property portfolio, at what time do you consolidate your debt and live off your passive income, and our key research fundamentals. So I'll provide a link below for you to have a look at. So, all right, guys, I hope you enjoyed today's presentation. It's a macro property outlook. In my opinion, in conclusion, I believe we still have a very strong property market, which is expected to continue to grow. And I believe interest rates are peaking very, very soon. So now is definitely time to take advantage of everything. Take advantage of this buyer's market. All right, guys, hope you enjoyed it. If you did enjoy this presentation, please share it with your friends. Please invite your friends, colleagues, and family to join the Property Masterminds group, where they're going to get tons of value. All right, guys, so until next time, I'll see you then.